Have you ever been told that good debt exists? The kind that helps you grow, that pays for itself, that leverages your money. Sounds convincing, doesn't it? But today, I am going to show you why that label can be a dangerous trap and how to keep an apparently good debt from becoming the heaviest weight on your finances. Take a deep breath. I'm not here to demonize credit. I'm here to teach you how to examine it with a magnifying glass so your financial decisions are truly yours, not the bank's, not the advertisers, and not the result of social pressure. Let's begin. The promise of easy credit is everywhere, and it's seductive. Buy now, pay later. 0 interest for the first month. Instant approval. Your brain hears opportunity, but your bank account hears commitment. Easy credit isn't a gift, it's a contract. And every single contract has conditions, risks, and hidden costs. Remember this, the faster the approval, the slower you should read the fine print. So, what about this concept of good debt? Who says it's good? We're told it's debt that creates value. The classic examples are a student loan for education, a loan to start your own business, a mortgage for a home, or financing for tools that help you produce. Yes, these asterisks can be strategic, but the potential to create value is not the same as a guarantee of creating value. And that's where the trap lies. The label good debt can switch off your critical thinking. It makes you lower your guard, and when your guard is down, your financial risk skyrockets. Before you ever take on any debt, no matter how good it sounds, you must ask yourself these 3 critical questions. First, does this credit increase my actual cash flow, or just my hope? If the money you borrow doesn't create real, measurable, and reasonably predictable income, it's likely not a tool, it's a burden. Second, does the benefit comfortably exceed the total cost of the credit? I'm not talking about the monthly cost or the affordable installment. I mean the total cost, including every penny of interest, all taxes, fees, and insurance. Calculate the full picture. Third, and this is crucial, can I withstand an adverse scenario? What happens if sales are lower than expected, a project gets delayed, the interest rate goes up, or you face an unexpected medical bill? If your plan only works if everything goes perfectly, it's not a plan, it's a wish. Our own minds often work against us here. There are powerful mental biases that push us into debt. First is the present bias. We are hardwired to prefer immediate pleasure over future rewards. We want to enjoy something today and worry about the consequences later. Then there's loss aversion. The pain of forgoing a desire, missing out on that shiny new thing can feel worse than accepting a high interest rate. So we overpay, just to avoid feeling like we missed out. Finally, there's overconfidence. I'm in control. My business is about to take off. 6 months from now, I'll be flush with cash, maybe. But the bank isn't financing your dreams, it's financing your documented ability to repay. Recognizing these biases doesn't make you cold or cynical, it makes you responsible. Let's look at when good debt goes wrong. Imagine you finance an expensive graduate degree. It makes perfect sense if it boosts your employability and income. But what if that job market becomes saturated? What if it takes you 2 years, not 6 months, to land the job you were counting on? What if the new salary isn't enough to cover the loan payment without completely choking your quality of life? The same debt, at the same interest rate, can be a brilliant opportunity or a crushing shackle. The difference isn't the label, it's the context and your plan. Or think of a business. You borrow money to buy new equipment, projecting optimistic sales figures. But clients take time to show up. Your cash flow doesn't cover the loan payments. So you start using a credit card just for now to cover the gap. And that for now quickly becomes a hamster wheel of debt. It wasn't bad debt, it was debt without a safety net. This brings us to the affordable payment trap. Banks and lenders have mastered this psychological trick. If the monthly installment looks small, our minds are more likely to say yes. To achieve this, they extend the loan term, offer grace periods, add insurance, and bundle other services. The monthly payment goes down, but the total cost you pay over the life of the loan skyrockets. Your attention gets locked on the question, can I afford this monthly? But the inner accountant inside you must scream, how much will I pay in total? Sometimes the difference is brutal. If you only ask if you can afford the payment, you've already fallen into the trap. Let's quickly demystify a few common credit products. Revolving credit, like a credit card, you pay a portion, your credit limit frees up, and you can use it again. It feels like freedom. In reality, the interest rates are often higher than almost any other form of financing. Then there are no interest installments. Sometimes they are genuinely interest-free, but other times, the base price of the item is inflated, they charge a maintenance fee, or they tie you to very specific conditions. If you fail to comply with those conditions exactly, the cost explodes. And finally, refinancing. This lowers your monthly payment in exchange for stretching out the life of your debt. It provides relief today but chains you to payments for much longer tomorrow. I'm not saying these products are inherently evil. I'm saying that if you don't understand the mechanism will understand you and use it to its advantage. There are also two invisible costs of debt that we rarely calculate. The first is opportunity cost. Every dollar you pay in interest is a dollar you didn't invest in your future. It's a dollar that could have been earning interest asterisk for asterisk you, not for the bank. The second is the emotional cost. The stress of sleeping with payments, due dates, and balances constantly on your mind. That stress steals your creativity, your focus, and even your physical health. It's not listed in the contract, but you feel it in every aspect of your life. So, when can borrowing actually make sense? There are moments when credit can be a strategic tool. First, when there is a high probability that the asset you're buying will generate income well above the total cost of the credit. Not in theory, but proven with numbers and realistic scenarios. Second, when the credit reduces a larger risk. For example, taking a loan for a necessary home repair that prevents a much bigger, more expensive problem later on. Third, when the debt is used to replace a destructive financial habit and has a clear exit plan. For example, consolidating multiple high-interest credit card debts into a single, cheaper loan with a short term, but this must be paired with a real commitment not to run up those credit card balances again. Even in these cases, the key word is always discipline. So, here's the golden rule before you sign anything. Answer these questions out loud. What am I really buying with this debt? Is it a productive asset, or is it a desire wrapped in a convenient justification? What is the total cost in a reasonable worst-case scenario? If the interest rate rises, if my income drops, if the project is delayed. And finally, how do I get out of this debt if something goes wrong? You need a plan B, a plan C, and even a plan D. If you don't have clear, concrete answers to these questions, do not sign. And if you do, read them again tomorrow. Truly good debts can survive a night's sleep. Pay attention to red flags in your own thinking. If you hear yourself saying, I'll just pay this installment with another credit card, or every month I have to use my credit limit again, or I know the interest is eating me alive, but I have no choice, or according to my plan, everything will improve next month, and that next month never seems to come. A red flag isn't a tragedy, it's a warning light. It's a signal to ask for help, to negotiate with your creditors, to cut non-essential expenses, to sell things you don't use, and to find extra income. Above all, it means you have to stop the bleeding. Do not add more debt to the pile without a concrete exit plan. Here's a simple, 3-step method for making a decision. 1. Cool the emotion. Never take on credit the same day the idea pops into your head. Give it at least 24 hours. Always. 2. Evaluate with simple numbers. How much money comes in? How much goes out? What is the total cost? How long will this debt tie me down? Do I have a clear exit plan? 3. Apply the yes even with pain rule. If this credit cost a little more than advertised, would I still say yes? If your answer changes under a slightly more pessimistic scenario, your decision is based on luck, not strategy. Good decisions don't rely on willpower alone, they rely on systems. Automate your savings so money is set aside before you can spend it. Set spending caps for different categories in your budget. Avoid storing your payment information on impulse buy websites. And create a small, allow temptation funds so your impulses have a designated space to play without eating your future. If you do choose to borrow, make a contract with yourself. Define a maximum amount, a maximum term, and the maximum percentage of your income you'll assign to debt. Consider two stories. Person A takes out a loan for an expensive course without researching the job market. They're stuck with high installments, but their income doesn't increase. Their stress skyrockets. The result? They refinance, pay for far longer, and give up on saving for their future. Now, person B. They take a loan for a new machine, but they already have clients and signed contracts waiting. They have a forecast for their cash flow, they include insurance in their costs, and they have an active emergency fund. They choose a short loan term and make extra principal payments whenever possible. The result? They pay off the loan early, their cash flow becomes positive, and they experience real, sustainable growth. The difference isn't the interest rate, it's the system. Ultimately, there is no such thing as good debt by decree. There is only debt that is well designed, well measured, and well executed. And there is debt taken on impulse, under pressure, or based on an illusion. The first kind can help you build your future. The second kind will bind you to your past. Before you sign that paper, remember this: the bank doesn't evaluate your dreams, it evaluates your capacity to pay. Your job is to evaluate your life plan. Make sure every single dollar you owe has a powerful and productive reason to exist. Let your debt add to your freedom, not mortgage it. If this message helped you, please consider taking care of someone else by sharing it. Because the easy credit trap is avoided with one hard decision: to think first and sign later. And if you are struggling with debt today, know that you are not alone, and there is a way out. It starts with calm, with numbers, and with a plan. This isn't about blame. It's about taking back control. Thanks for watching, and don't forget to subscribe for more content to help you master your money.